Hi and welcome to the session on credit cards and credit ratings. We've combined these two this year because we really think you can't really do one without the other, to be honest. So it's a slightly longer session than you would have seen last year, but hopefully it all will make perfect sense. Now you will need to have downloaded two of the activity sheets, which you can find on this page. So get those downloaded now before you actually start with the video. Okay, so credit cards always get two complete contrasting views on these. So just have a quick go around the class now and who thinks credit cards are bad and what reason? And conversely, who thinks credit cards are good and again what reason? And an awful lot of our preconceptions with credit cards probably comes from family members who've had good or bad experiences with them. What we're going to try and leave you with today is enough information for you to be able to make a good choice for what's going to suit you as a person going forward. So how are we going to do that today? Well, we're going to look at what credit cards are to start with and also how they work, because although a lot of us think it's going to be dead simple, they are actually a little bit more complicated than you might think. We're going to look at two very important tools, direct debits and standing orders. We use those well. We can actually save ourselves quite a lot of money when we're using credit cards. And then we'll be looking at the benefits and drawbacks of credit cards and then going into some top tips. And then we'll be moving on to credit ratings. And as I say, they're fairly inextricably linked, these two topics. So first of all, little activity just to get everyone warmed up. Could you please match the words on the left to the definitions on the right? Now you might want to sort of pause the video as we go through, but I'm going to go through these quite quickly. First of all, annual percentage rate is the cost of using credit expressed as a yearly rate. Now APR is something that all lenders have to show when they advertise their loan. It really is there so that us consumers can look and compare at the cost of loans. The only problem is with an APR that not all loans are designed to be used over the course of a year, so APR can be a little bit confusing, but that's what it is. Monthly interest is the cost of using credit expressed as a monthly rate. Now that's what we'll see when we come to credit cards, because we will normally see the credit card advertised with an APR, but when it comes to the interest being applied, it's applied monthly, so we use a monthly interest rate to do that. Our balance is the amount left to be paid after we have made our payment for that month. So our balance is only after payments have been made, not before. Late payment fee is a charge that you are made or is made to you if you don't make your payment on time. It won't be a great deal of money, maybe 20, 25 quid. The real hurt on that is if we miss a payment, is that it can negatively impact our credit score or our credit rating. Minimum repayment, every credit card issuer will have this. It's the smallest amount that you can pay every month. You don't get to choose whether you pay or not. You have to repay something every month, and the least you can repay is your minimum repayment, and that will vary with your balance and also with the card. An overdraft. Now, whilst a credit card is not an overdraft, it is worthwhile just sort of spending a minute or two just thinking about what an overdraft is. Now, an overdraft is given by your existing bankers to your existing bank account, and it's the amount that you are allowed to go overdrawn, so the amount of money that you can spend that isn't yours, it's the bank's, which will then have to be repaid at a later date. Now there is normally a fee to set up an overdraft, but that overdraft will then last for as long as you want it to be there. You don't have to use it all the time, so you can dip in and out of your overdraft, use a little bit of it, repay, use a little bit more, repay, etc., etc. Your credit card does not have to be issued by your bankers. You're still using somebody else's money, but it's not linked to your current account. And then finally, your grace period, which is the number of days to pay your bill without incurring fees. So you may be given a bill on the 1st of the month and they may say, well, you have until the 15th of the month to pay your minimum payment. Those 14 days between the 1st and the 15th is your grace period. So let's look at what a credit card is. So it's like a debit card, which you're all very familiar with, I'm sure, but with borrowed money. And as I said just now, it doesn't have to be issued by your bank. It could be issued by, loads of different people. It could be Amazon, it could be Sainsbury's, it could be Barclays, it could be NatWest, it could be anybody, but it doesn't have to be the same as the bank that you're currently banking with. Now, when you get your credit card, you will have a limit, and that limit will be based on your circumstances. So if you're quite new to the credit card game, then your limit, which is the total amount of money that you can spend at any one point of time, will be relatively small. And by that, it could be about 250 quid. As you show good practice and you show that you can handle credit comfortably, then your credit card company will increase your limit, even if you say that you don't want it. They may still try and increase it, but you are in control. Go back to your credit card company if you don't want that extra limit and ask them to take it away and give you back the limit that you had beforehand. So always bear in mind that you're in control, not they are in control of you. The credit card will add interest to money that you have not repaid. So any money that's owed at the end of the month, you will have to pay interest on that outstanding amount. And that will depend on the APR of the credit card. And that again will vary from supplier to supplier. As I've already said, there are many different types of cards, not all from banks. Could be Amazon, could be Sainsbury's, could be Marks and Spencer's. It's unlikely that you're going to be borrowing the money from Amazon and Sainsbury's, etc. They are basically just wrapping up somebody else's credit card in their own wrapper and then letting you use that in their name. But it won't be them that's actually giving you the money. It's worthwhile mentioning that. And the other big difference between an overdraft, which I mentioned earlier on, and credit card is that you can have multiple credit cards. You don't have to have one, although I would strongly suggest not getting into the realms of multiple credit cards unless you can actually help it. So let's have a quick look then at how these credit cards work. So when you apply, you will be given a credit limit, which is the maximum amount that you're going to be allowed to spend on that card. And you will also be told what the APR is, which is the interest rate that you'll be charged on unrepaid funds. So let's assume here that you have been given a limit of maybe 300 quid. You then spend it, any part of that £300, but only up to the £300. Come the bill at the end of the month, you have a choice. You can either pay back the whole amount at the end of the month from your bank account, then you will incur no interest and your credit limit will be reset back to the full amount again. So as an example, you had a credit limit of 300, you spent £200 on a laptop. Come the end of the month when your bill came in, you repaid that whole £200 from your current account. Therefore, you incurred no interest on your credit card and your new credit limit, the beginning of the next month, is reset back to £300. You have a choice though. You could pay back part of what you owe at the end of the month and then you will incur interest at the rate of the APR divided by 12, because remember, it's a monthly interest amount that you're paying. Using our example again, if you had your £300 limit, you spent £200 of it, and then at the end of the month you only repaid £100, that means you would be charged interest on the £100 that still remains unpaid. So if your APR was 24%, that equates to just under 2% a month. It's not exactly 2% because it is compounding, so it's just under 2% a month. You would have 2% of the £100 applied to your credit limit, and your balance would then be about £102 on your limit on your credit card, which means then your new limit for the next month would be 300 less the amount you owed, so it would be about £198. So hopefully that makes sense on how that works. You will then have that same choice to make every single month as you go forward. Now, it's definitely worthwhile keeping an eye on the APR, because the APR will give you a flavour for how much interest you are likely to pay. But remember, when it's actually calculating the amount that's going to be applied to your balance, then that would be the APR divided by 12. In fact, it's slightly more than 12 because, as I say, the interest is going to be compounding. Please watch out for any hidden fees or high interest rates that are in there. Some credit card lenders will penalise you as a brand new credit card user. They will charge you a bit more until you've been using it for a few months, and then the rate may move down a little bit. But all of that stuff should be available and visual up front. If a deal looks too good to be true, it probably is. There are 0% deals out there, but unfortunately not for new users. You need to show that you've got a very good credit history, so your credit rating is good, and then you may well be able to open up one of the new zero interest rate cards that are out there. That will normally be on old balances that are exchanged to that new card. But it might actually be on new purchases as well. So worthwhile doing a little bit of homework on there. Watch out for any late payment penalties. Yes, they will sting, not just from a financial point of view, but as I intimated earlier on, your credit score will suffer if you fail to make a payment on time. Work out your cash flow carefully. Miscalculation can mess up your budget. So if you had intended to repay, going back to our example, the £200 for the laptop, but your budget ran away with you a little bit, you overspent somewhere along the line, you might not be able to pay the whole amount back, which means you are going to start incurring interest that you weren't normally expecting to do so. So let's go back to an example. We had a £500 limit on this particular card. We had an unpaid balance from last month. We had some options. We didn't spend any more, but our options were at the end of the next month, pay the whole lot back in full. Everything's reset then to £500 going forward. And of course, you incur no interest in doing so. You can pay back the minimum amount that's required by the credit card provider. You would normally do this through a direct debit, and I'll tell you a little bit more about that in a minute, so that your bank automatically pays that minimum amount on a given day, which takes all of the sort of memory work out of it as far as you're concerned. That's there really to make life a lot easier for you. Or you can pay back a custom amount between the minimum amount and the full amount. So you've got three options: pay it all back, pay back the minimum amount, or pay back something between the minimum amount and the full amount. First option, paying back in full, of course, no interest. The second two options means that you will incur a little bit of interest. So how do you manage your account well? So spending money through your credit card, yes, paying it all back in full. You can do that either manually, or you can set up a direct debit to pay the whole lot back every single month. You won't know how much that is, of course, because the amount will vary, but your direct debit, if you choose to use that method, will have two tick boxes. You can either pay back the minimum amount or the full amount. You tick the box for the full amount and then it will be paid. But bear in mind that if you get a bit too carried away with spending on your credit card, you might end up paying it all back, but at the cost of the amount of money you've got in your current account. So it is a bit of a balancing act, so you have to be careful with that. If you choose to pay a minimum amount or a custom amount, you can do that by paying through a direct debit. If you choose the minimum amount, you just tick that box, as I said earlier on, or you can set up something called a standing order, whereby you can pay a fixed amount every month, more than the minimum payment, but you won't need to keep on worrying about changing it. You can leave it at the exact same amount, and that will be done by your bank every single month. Those two methods, using the direct debit and the standing order, ensures that you do not miss any payments. So it takes all of that worry away from you. So it's really quite a useful way of actually paying back your bill every month. So let's look now then at the difference between a direct debit and a standing order. They are very closely related, and you may even be using a direct debit already. By signing a direct debit, what you're saying is that you are allowing the person that you sign the direct debit with, so it could be a telephone company, it could be your credit card company, to come in and ask for a variable amount of money every month to pay the bill. Now, it's useful if we're paying the whole lot back, or it's useful if we're paying the minimum amount back. Many of you will be using that to pay for your mobile phone bill, because that could vary every single month, so we don't know exactly what that's going to be. So direct debit's really useful for when it comes to that. Only works when you've got enough funds in your account to cover the direct debit. If there's not enough money in there to cover the cost of the direct debit, it will remain unpaid. So then you will start to incur these late payment fees. And of course, you'll get a hit on your credit score. Very simple to set up, and you set it up generally with the company that you are working with, not through the bank directly, but it goes via the bank once you've set it up with the company. Right, now the standing order, as I said, very, very similar, but with the standing order, you pay exactly the same amount of money each month on exactly the same day. So you're instructing your bank to make the payment on your behalf to the company, and not, as with the direct debit, allowing the company to come in and request the money from your bank. So we would tend to use a standing order more for regular payments, like our mortgage, which doesn't change, or for loans, or for budgeting pots, things like that. Really worthwhile if we were putting an amount away every month into our savings. We would tend to use a standing order for that, because it's exactly the same amount every month. And that works again when you have enough funds in your account. If you don't have that money in there, or you don't have an overdraft to cover it, then it won't be paid, and of course you will incur the costs associated with that as well. When you set it up, you set that up direct with your bank, and you will need the details of the person or the company that you're sending that money to, so their name, their account number and sort code and things like that. So those are the two differences between direct debits and standing orders. So why is that so important? Well, by choosing the right one, you can save yourself a fortune when it comes to credit cards. Let's look at a particular example. So let's assume we have a balance on our credit card of 500 quid. The APR is 20%. We have minimum repayment terms of 1% of the balance plus interest, 2.25% of the balance, or a fiver, whatever is the minimum repayment. So for the first one, 1% of the balance plus interest, 1% of the balance would be a fiver. Interest on that would be £8.33. That comes to £13.33. If it was 2.25% of the balance, it's £11.25, or obviously a fiver is a fiver. So whichever is the greatest. So on this occasion, it's £13.33. Now, if when we took our credit card out, we set up a direct debit only to repay the minimum amount every month, how long do you reckon it would take to pay back the balance completely? You could pause the video here if you wanted to and just have a little straw poll around the class. I'll leave it up to you. Now, if you decided to repay via a direct debit the minimum balance every month, then that will go down along with your balance. So the minimum payment goes down with the balance because it's done on a percentage of the balance outstanding. Believe it or not, to repay your £500 would take you almost 13 years. And the amount that you'd have to repay would be more in interest than the amount of money you borrowed. It would be almost £1,100. That's if you chose the direct debit route. My suggestion is don't go down the direct debit route, replace that with a standing order, but keep the amount at £13.33 so it will not decrease as the balance comes down. Just think what happens then. Right, if you've had a little chat amongst yourselves about that, now I'll show you exactly what does happen. So instead of writing out a direct debit, we put in a standing order. And we kept the amount at £13.33, the exact same amount as it was going to be through our direct debit in the first month. The amount of time it now takes to repay, and bear in mind we're not paying any more money back at all, we've just changed one direct debit into a standing order, goes down from 12 years and 10 months to just 4 years and 9 months. And the amount we repay goes down to £749 from just under £1,100. So there is a huge difference. Right, I'm going to get you now to do a little activity. If you take a screenshot of the QR code on the screen now, it will take you to Barclays Budget Calculator. It's a repayment calculator. What I'd like you to do, please, is to put in a balance of £500 with an APR of 21.9%. and then work out how long it would take if you increased your monthly repayment to £20, to £30 and to £35. I'll give you a minute or two to do that. Just pause the video while you complete these different numbers. Okay, well, hopefully you've all got some figures in there. If we chose to repay £20, the time taken to repay comes down now to 2 years and 9 months. The total repayment amount is 652, which means the interest is 152. So we've cut the amount of time down again by increasing the amount. What about if we could afford £30 a month? Well, then the time goes down to 1 year and 8 months with a total repayment of 590, and our interest now is just £90. If we could afford £35, goes down to 1 year and 5 months, £576 with £76 of interest. So the moral of the story there is don't repay the minimum amount every month. Pay back a fixed amount that you can reasonably afford, and it will pay you dividends to actually do so. You'll cut down the amount of time it takes you to repay your debt, and you'll cut down on the amount of interest that you're going to be charged. Right, you've now got a second activity. On this particular activity, I'm going to show you a credit card statement, if you like. It's a mock-up of a statement. What I would like you to do is to look at where things go or could be done better. So, for example, cross off the areas which could have been done better. I think I've done the first one for you here. Previous balance 755.36. I put a cross next to that. If we could have made that balance smaller, then we would have paid less interest. So I'm going to stop. I would ask you to stop the video now and then cross off all of the bits that you think we could have done better by doing something different. Okay, so we did the first one, the previous balance we could have made smaller. Next one I would hope that you crossed off would be our purchases. We've made quite a lot of purchases there. We've got £329.33 in purchases. Were they all absolutely necessary? Just use our credit card for purchases that are completely necessary and not on impulse buys. Next thing you could have crossed out would be cash advances. Getting cash out on your credit card is expensive. You'll be charged a fee every time you do it. You can see there we've drawn out 40 quid, but the fee charge was £17. So be very, very careful when you're drawing out money on credit cards. It's expensive. This goes on top of what you might be charged in interest as well. Next one, because we had quite a high balance, we were charged £7.52 in interest. So we could pay less by paying more back every month. That would be a much better way of doing it. It would give us a smaller balance as well going forward. Next one, our balance is now £989, very, very near our credit limit of £1,000. So we don't like that. Not only that, we don't like the fact that credit ratings agencies will be looking at this as well, and they'll downgrade us because we're very, very near our credit limit. And then the last cross that I would hope you'd put on there, our last payment was overdue. So that means we were going to incur fees and also late payment charges next month. So it's not a good place to be in. So our minimum payment is due 15 quid. We should try where possible to do more than that. Okay, keeping on the activity theme, I would like you now to look at the stuff that we bought on our credit card. Could you please cross off the bad spending decisions? So go through there and look down what were the things that probably was not a good spending choice. Pause the video, give yourself a few minutes to do it. Okay, so this is all going to be very much your personal view, but I'm going to start off by saying my Bling King expensive fake jewels at £160.20 probably wasn't a very good buy, because if you look further down, we've had to send them back. We've got our money back. We got our £160.20 back, but perhaps it wasn't a very wise choice in the first place. Next one, my cash advance, really not a good call. £40 we got out, that cost us a fiver. We did show £17 in the earlier slide, if you remember. £12 of that would have been the part of the late payment fee. So £5 for our cash advance and £12 for our late payment fee. Next one, we had an over limit fee. That was the 12 quid that I was talking about just now. That wouldn't have happened if we hadn't have gone over our limit. What isn't shown on there is the effect it has on our credit rating, which can be quite bad. And then the next one, right at the very end there, sticking a pizza on there, not perhaps the best choice of spending our credit, and also going in and buying some sweets at the Delicate Truffle Emporium. Perhaps not a good idea either. Perhaps we needed to, though. Perhaps that could have been a present for somebody. I don't really know. So those, I think, possibly I could have made better choices when I was actually looking to spend my money. So let's look at a couple of pointers just before we end up on this part of it. First of all, when you get your first card, if it's a student credit card, that is likely to be linked to a student account and will probably have a high APR. That's not unusual. You've got no record to actually show. So be prepared. Your APR is likely to be quite high right at the beginning. Secondly, your credit limit is likely to be very small. That's no bad thing. It means you're not going to be too tempted to spend more money than you can actually afford to repay. Your minimum repayment is likely to be high. Again, that's quite a good habit to get in, to pay a little bit more back every month. And one really good thing that is worth bearing in mind is that you have purchase protection on items above 100 quid. The way that works is that anything that you buy which is as a single item more than £100, if something went wrong, you could normally take it back to the shop. If that shop had gone bust in the interim, your credit card company will refund you the difference. So I would really strongly recommend, if you are about to go on holiday and you can afford to put the whole lot on your credit card, pay for your holiday on your credit card, then pay the whole balance off straight away because you would have had that money saved up. It does mean that if your holiday is cancelled because the holiday company goes bust, you have got some protection over and above what the holiday people may have given you. You've got some protection through your credit card as well. And to finish off, let's just look at the risks and benefits of our credit cards. One of the risks, we can end up spending more money than we can realistically afford because there is a temptation to go out there and put everything onto your credit card. You've got this money that's sitting there that is there to be spent, or so you might think. And you might think, oh, that's a free source of money. I can really go out and do what I want. But you will have to pay interest on it, and your interest rates are going to be fairly high. There is a temptation as well. Once we've filled up one credit card, we might go and get another one. Credit ratings agencies look very dimly on this, so please don't be tempted into going down that route. So what are some of the benefits then, if those are the risks? Well, you can shop around and perhaps get some deals and offers. Credit card companies want to tempt you to coming in and being one of their clients. So from that angle, there will be deals and offers on display. You might be able to accumulate reward points and use those against some future purchases. Really big one, it could help build your credit score if you do it well. But if you do it badly, of course, it's the opposite is going to happen. It's going to be detrimental to your credit score. There's going to be an extra layer of security against fraud or identity theft. The credit card companies are giving you their money, remember, so they want to protect that just as much as you do. So they will generally be a lot more careful with the layers of security that are there over and above your banks. And then our added protection, of course, for cancellations and other refund issues. And as I've already mentioned, your purchase protection on items above 100 quid. When you're getting your credit card, look for deals and offers that are out there. Do your research carefully. If you can get a referral from somebody that's already got an account with that credit card company, there may be some instant benefits. There may be a little bit of a cashback reward, which you might be able to split. Don't break a credit limit. It is expensive, not just from the fine, but also from the credit rating depression that you're likely to get. Stay below 75% utilization. It's a really good tip because anything above 75%, unfortunately, the credit ratings agencies again don't like that very much at all. So try and stay below 75% where possible, and use direct debits and standing orders to automate your payments. Now, I did say that credit cards and credit ratings sort of go very much hand in glove. And you saw just now one of the benefits of having a credit card and using it properly is that it will benefit your credit rating. So what is a credit rating? Well, it's a number, and I'm not going to say between 0 and 999 because that can vary a little bit, but as far as this slide's concerned, I've got 999 on there. It's a number that you get as soon as you are 18. The higher the number shows that you are more credit worthy. And having a good credit score affects your ability to buy, rent and borrow. Having a bad credit score doesn't mean that you can't buy, rent and borrow. It's just that you will likely be charged more interest when you do so. There are 3 main agencies in the UK that look after your credit scores. Experian, that's the biggest by a long way, Equifax and Call Credit. They all use different methods to work out your credit score, and their top score is different in each case. So you may have a rating of 700 with Experian, 550 with Equifax and 600 with Call Credit. Don't mix them up and think that they are all exactly the same. They may mean the same thing, but the numbers are not interchangeable. Good score, nice high number, shows that you are reliable. Right, so what makes up your credit rating and who looks at it? Well, first up, the stuff that makes up your credit rating are all of these things: your payment history, your outstanding debt, being on the electoral register, and also your credit history. A mixture of all of those things will go up to make your number. Who looks at it? Pretty much everybody in finance. So anyone from banks, employers could actually look at it as well, credit card providers, utility companies, SkyTelly, all of those sort of people will all be looking at your credit score before they give you that service or the credit that you're actually after. So what can they see? So each of the companies can see your credit score, your credit file, your credit report, and your payday loan or payday payment history. Payday loans, be really careful. Don't be suckered into a payday loan. Not only are they really expensive, they sit on your file for years and years, and they will depress your credit score without a question of a doubt. But what won't these companies be able to see? Your race or your religion, your income or your savings, which might surprise you a little bit, any parking or driving fines. Strangely, they will not be able to see your criminal history if there is any of it. They certainly can't see your medical history. They are not allowed to take into account your student loans that's outstanding, and there's no other personal information that should be passed on to them. So all of those things they will not be able to see. Right, let's give you one last activity for this whole stuff that we've been doing. Place all of the items on the sheet that you've got into either of the columns, positive impact or negative impact. And I will give you a few minutes to do this, so pause the video now until you've all put those things into the columns that you think that they are. Okay, so hopefully you will have the same as me. Bills paid on time every time is positive for your credit score. Negative, though, will be open a few credit card accounts and never use them. This might surprise you. You might think because I've got a zero balance, it's not going to depress my credit score at all. You'd be wrong, because even if you have unpaid or unspent credit limit, the full credit limit goes against your credit history. So if you've got a credit card with a £2,000 limit on it, which you've spent nothing at all, it will still show up against you as £2,000 worth of debt. That might surprise you, but that's a good reason not to get more than one credit card out. Second, had a credit card with a high limit and a low balance, positive impact. We're way below that 75% utilisation threshold. That's got to be good. Next one, skipped a payment, made it up next month. Not good at all. It means you're going to be suffering from having to pay a fee or a fine for missing a payment, but the credit rating, as I've said before, will be depressed and will lose numbers because you missed that payment. Having a long credit history is very good. Opening up a few credit card accounts and maxing them out, no, really bad. Using 10% of available credit, nice and small, way below our 75% utilisation threshold. Very positive. Having a credit card with a high limit and a high balance, no, not good at all. We do not want to be using more than 75% of our limit. Having a broad mix of different credit types, yeah, that's good. Maybe a mortgage, personal loan, overdraft, credit card, all nice mixture, all being well looked after, all very positive. No credit history, sadly not much we can do about that, but if you never take out any credit, you can't expect to get a decent credit score for when you do need credit. So even though you might not like the idea of a credit card, it could be a good way to get ourselves a decent credit score, especially when we're younger. Check your credit report regularly and have incorrect information removed. Things will go wrong on there. Nobody's going to be looking at it other than you to put things right again. So make sure you keep abreast of all the things that go over your credit report. Using credit cards for impulse buys, we did a little activity on that a little while ago. You can see not really a great idea. So I would try and steer clear of that if I could. Use up to 30% of available credit. Brilliant. Way below our 75% threshold. Lots of credit checks may be done by lenders if you make lots and lots of inquiries back to each other, back to back. They stay on your credit score for a little while, so be careful not to put too many credit checks in next to each other. Finally, pay off a big outstanding balance. Lovely. Yes, it means we no longer now have any credit, so we lose out a little bit on that, but the very fact that we've paid it off will not be a penalty on that month, but won't help us going forward. Close the credit card account to begin paying it off? No. Pay it off first, close it afterwards. Closing it off first means that you'll be going directly into debt with that credit card. It's going to put pressure on everything else that you've got. Use a credit card to pay off another card. You might think that that's negative. It actually could be positive, because if you can find a deal with a lower APR on a card for balance transfers, by transferring the balance to a lower APR means you're going to end up paying less interest. That's got to be good. Choose a credit card with a high APR but giving you rewards. No, don't go for the rewards. If you can get a low APR or two cards, one with a low APR that doesn't give rewards, the other with a low APR that does give rewards, fine, go with the rewards, but don't take rewards over APR. Pay for your holiday on the credit card and pay it off in one go. You've got protection from your payment. So if the holiday company goes bust, you've got a little bit of protection in there from the credit card company as well. That's got to be good. Declare bankruptcy. Oh no, please don't go down that route unless you have no alternative, and think long and hard about those alternatives first. That stays on your credit record for many, many, many years. So even if it was 5 years ago, that will still be on your credit score. Paid off in full every month. Not as good as actually running some credit and showing you can do it properly, but still will give you a little bit of positive impact. Use a payday loan 2 years ago. No, don't go down the payday loan route. There is always a way, if you've got any sort of credit score at all, that you can get cheaper credit than a payday loan, which will not sit on your credit score for a long time. And last one, use 90% of available credit over the 75% threshold. Not a good idea. Right, I think, there is one more actually. Open many credit accounts in a short time. No, don't want to go down that route. And no, there's the last one. Use available credit as an income on your budget. Try not to, because as I said earlier on, taking money out as cash on your credit card's bad, and you will fill up your limit before you know it, which is going to be very negative on your credit score. Right, so what's the benefits of having a good rating? You'll get better access to loans and credit cards at better rates. You'll get buy now, pay later services that won't be available if you do not have a good credit rating. Once you've shown some good history, you'll have access to 0% interest deals. That will save you money in the long term. You'll get better interest rates on stuff that you do pay interest on. They will be lower, and you'll be able to switch utilities, so your electric company, your gas companies and things like that, with ease. Bad credit score, you're very likely to be put in to one of your utility providers, and you'll be stuck in with that one going forward. Right, so we know all the ways and that this is going to help us. So how do we start to build a good credit score when we're 18? Well, we can actually do a couple of things before we're 18 even, and I'll mention those in a minute. First of all, open a bank account early. As soon as you get the inkling to open a bank account, you haven't got to wait till you're 18, obviously. You can open that up. That is going to help us going forward. Be on the electoral register. When you are 18, you will have to be on the electoral register. It shows that you belong somewhere. That's positive as well. Don't be late on any payments or miss them. That could be a little bit later on this particular wheel. But the one that I did want to mention, pay for your mobile phone from your account. So even if mum and dad are paying for your mobile phone, ask them to put that money into your account and you pay for your phone from your account. You can do that before you're 18 as well. And that would actually put credit in the bank when it comes to your credit score. So there's young people out there that have been paying for their own mobile phone from the age of 16, found that when they got to 18, they already had a really, really strong credit score because all of that stuff was mounting up in the background before they actually got their credit number on their 18th birthday. Using our credit card effectively, maybe taking 50%, 60% of our limit, paying a good chunk of that back every month, topping it back up when it gets really low, back to that 60% level. Do that cycle 3 or 4 times, really, really the strongest way that you can build up your credit score. Please don't take out loans that you can't pay back or you will struggle to pay back, because as much good work as you can do can be undone by those loans if you miss any payments. You could have a utility bill in your name. That's going to be good, provided you make all the payments on time. Having a utility bill in your name, if payments are not made on time, will be negative. So just make sure if the bill's in your name, you make sure it's paid on time. And finally, check your credit rating regularly. So all of those things will help us to get a really good rating as quickly as we can. And by a good rating, I would say with Experian, somewhere around the 600 level is going to be really good by the time you leave uni. Give yourself a target to try and get to that. So what about keeping it at that level? Well, make sure that you do all of these things. Keep within that credit limit every month. Use under 50% to 75% of your total credit that's available. Make all your minimum payments, at least your minimum payments, on time. My advice, make more than your minimum payment. Check your credit file regularly. Appeal any irregularities that are on there. It could be just human error. And set up automatic payments using direct debits or standing orders to make sure you don't miss those cut-off dates. Please don't put in credit applications together. So look for lots of different things where you might be using credit. Break any pre-arranged limits, a big no-no. Don't leave a credit card at or near its limit. Steer clear of using the credit card for any impulse buys. Never be late on payments. We've done that one to death, but it's worthwhile reiterating. Don't take out unnecessary personal loans when you don't really need it. And don't leave a credit account open after you've repaid it back, because it will show against your credit score as a full credit amount against you. So all of those things will help you keep your credit score really, really healthy. So be safe with it. Use it sensibly. Use it carefully. Get yourself a good credit score. It's going to pay you back all the way through your life.